It gives me a great pleasure now to welcome Mr. Ramesh Damani on ET Now. Over the years, I've interacted with him almost 2 decades now. I've learned a lot from Ramesh Damani as an investor and more importantly, Ramesh Damani as an individual human being. So it's an absolute delight and I always look forward to interacting with him. Our viewers rather, more than me, look forward to hearing your views. Mr. Damani, good morning. How you been? Long time.
Good morning, Nikunj. Thank you so much. Yes, I've been just fine. As you know, I've been my grandfather, so I'm enjoying grandfather road, and plus I've been traveling, so I've been a bit remiss not being able to come as often as you've asked me. But thank you so much for inviting me today.
Mr. Damani, while the consensus call on India has been well received and it is well documented, but last 12, 18 months, the markets per se have been difficult to call. Extreme volatility, lot of sectoral churn, and if I take the banking sector aside, the leadership in this market is lacking.
Um, let me address these points, Nikunj. First of all, let's take the budget. This was the first post-pandemic budget in 3 or 4 years, where the government, had some fiscal leeway and they weren't doing fiscal stimulus out there. And this is the challenge that I feel New Delhi faced, that our great geopolitical rival is China. And India is a much younger country than China. It has, I think, 350 million people below 14 years of age. China has only 250 million people below 14 years of age. But despite that, India's GDP is now only 16% of China's GDP, which was as high as 60% maybe 3, 4 decades back. So the central problem that our planners face is how does make India, China competitive with each other? Given the geopolitical situation, the world needs a strong India. So the budget decided, I think correctly, to focus on infrastructure, to focus on capex, and to focus on PLI. Because while India has become a good cyber power, superpower, a lot of good jobs are in technology. If India has to compete with China economically and have the heft and the military clout, it needs a GDP to match China's. And that can only come through manufacturing and manufacturing jobs. So I think by building on infrastructure so ruthlessly, as this government has been doing for the next 5, 10 years and the last 5, 10 years, I think that will step up the pace of investment in the economy. So while at this time it might seem that we're still sluggish, I think we're laying the groundwork for catching up with China in the next decade or so. And it's imperative that we do that because we have, so many young people coming to the workforce in the next 4 to 5 years.
But Mr. Damani, some would argue that while things are just moving in the right direction for the economy per se, the markets have been stuck in a range. Last 12, 13 months, Nifty has just gone nowhere.
Because I get very weary of people saying that. I mean, the index has doubled in 3 years. I mean, if you expect more than that, I don't think the stock market is the place for you. I think it's done well. You pick stocks bottom up, you've done well. The index itself has doubled. Forget picking the stocks. So markets can go through periods of consolidation. This was a disappointing earnings season, as you said. So that's fine. But I think the point I always make is that the bull market that started when the finance minister announced the long-term rates in income tax for corporate India 25% is still intact. It's still headed higher. And I would wager to you that we're just consolidating before we move up the next leg higher. I get a bit, impatient with people who believe that the index should go up linearly 15, 18% a year. Otherwise, things are not good. I just don't think that's true.
A lot of brokerages are making a view that, okay, India is a great story, but it's an expensive market, which is that you are pretty much buying silver at the price of gold.
You can say that about individual stocks. I talked to a fund manager at Fidelity a few days back, and he said, in his opinion, India deserves a higher P than the other emerging markets basket because there's a better respect for capital, the high interest rates out there, and they don't socialize profits as some of the emerging markets are doing. And I think India as an emerging market class will always trade at a slightly higher PE because the amount of high quality, high governance companies is relatively poor and relatively restricted. So the companies that everyone wants to get into, particularly the retail India, they know what the good companies are because they've, they have local nuance, will probably trade at a premium to the rest of the basket in Asia and maybe even America. But I mean, that's historically been true. Now, if you can't stomach some of the high PEs, I still think we look far enough. You get some more attractive stocks at lower P's. But I think that's parcel of investing in India is finding good businesses with good cash flows and good management and not worrying overly about the price earnings ratio.
I'm going to take a leaf from your earlier answer that the bull market is still alive and kicking. And this is a question which, in a sense, is for the larger audience and for folks who got SIP and who are now compulsory sticking to that asset allocation. So, if the starting point is today, which is 16th of Feb 2023, do you think in next 3 to 4 years it is reasonable to expect that equities will give a double-digit CAGR return?
See, I hope so. I mean, just to answer your question point blank, I hope so, and I believe so, and I'm positioned for it to do that way. But I think you need to understand the intellectual reasons why there's a band of people who seem so bullish on India, and I include myself one of them. Despite all the current imbroglio that's going on with other parts of corporate India or the sluggishness of the economy, the poor earnings season that we went through, every bull market has a reason, Nikunj, as you know. Let's say the 92 bull market, it visualized liberalization was going to take place in India. Say the 2000 bull market, it visualized India was becoming a technology superpower. So what is the intellectual reason why this market has been headed higher? Why has it doubled since the post-COVID lows? I think there are two reasons. One is demographic and one is a geographic position. Let me take both of them and explain to you. Let's see about the demographic reasons India is going up. Over the next 20, 30, 40 years, China is going to lose 250 million of its population, and India is going to add 250 million population. So India's population is still rising while China is declining. Now, what is the forecast for GDP growth? You need population growth, plus you need productivity growth. So India is in a good position to do that, if you will, because you're adding so many people, so many new consumers into the economy. The second reason is the geopolitical importance. I think the world has realized they need a counterbalance to China. And if you look at the Asia Pacific region, there's only one economy that can challenge China's in terms of heft and size, and that is India. So we are at the right place at the right time. And because of the huge push we made in the last 10 years in infrastructure and continue to do that, and the understanding that if India has to catch up with China, we need a manufacturing strategy, we need a service strategy, and we need to provide leadership in the region. I think because of our political stability, because of our demographics, because of the geopolitical where India is situated in the world as a counterbalance to China, I think all those are the intellectual reasons I point out that this market will outperform for a long period of time. And the idea that because you don't outperform 1 quarter or 3 quarters or 4 quarters, and people say, oh, it's over, the bull market is over, I think that belies what has happened in the last 40 years in India, where the index has gone, as you are well aware, from under 600 to over 60,000 right now. So I think it doesn't pay to be bearish on India. It pays to be bullish. It pays to be invested. And for whatever it's worth, I think I've heard these naysayers for a number of years, but I would remain invested in high quality businesses.
I'm going to switch sides officially from the bearish side to the bullish side. And let's have the glass half full approach, Mr. Damani. Whatever could go wrong has gone wrong this year for equities. The Adani group fiasco, pent-up FI selling, lot of volatility in terms of how the earnings season has been. But Nifty is still holding on. So can I say that somewhere the ability of this market to stand up to the bad news is quite remarkable?
Of course, Nikunj, that is the hallmark of a bull market, that the market goes down and rallies back. It's sharp, swift, and very quick. You can be cute and time the market, and maybe you'll get it right a few times. You'll be selling at the top and buying at the bottom. But a long career, you'll miss some of the great opportunities in life. If you had, when I came back to India in the late 80s, if you told me that over the next 30 years, India would go through various problems, global financial crisis, Cargill, change of governments, whatever, I would thought maybe India isn't a hot place to invest. But we've been through all of that. We've been through demonetization. We've been through inflationary periods. We've been through election changes. And yet the index is fairly close to its all-time highs, 5% below its all-time highs, perhaps. So I'm not sure what the pessimism is. And what is your alternative? I mean, your alternative is putting in fixed deposits in India, in which you're going to lose money on a real-time basis, because the purchasing power will be eroded by inflation and taxes. So equity is a great place. I think the Indian public has wisened up to this market. Yields are good, returns are good. And if you get a subpar return for 1 or 2 years, that's just part of doing business in equity markets. I mean, I think the biggest myth people have is the equities should give linear returns. They should go up 12, 15% like clockwork every year. Unfortunately, that can and will never happen, because if it happens, the stock market institution will, cease to exist. It always goes between fear and greed. And right now, there's somewhat more pessimism than is warranted by actual reality on the ground.
Adani group of stocks, Mr. Damani, they have been at the center of the storm. Should one look through it?
I missed the question.
Should one look through? Should one look through what is happening in Adani group of stocks in terms of the impact it will have on the markets?
I think so. I mean, I don't particularly follow that group because, as you know, Nikunj, I follow the small cap and mid cap space more aggressively. So it's a bit above my pay scale, and we'll see what report SEBI comes up with finally. But to answer your question straight on, yes, we should look through it. I mean, if there's collateral damage, we have to deal with it. But I think my best advice to people, and the way I'm positioning my portfolio, is to remain fully invested in this Indian market. I think it would be a mistake to try and get too cute and get out of this market.
But in terms of real impact, because the Adani group in a sense is a leverage group, and since banks have exposure to them, do you think there could be collateral damage on that account?
Again, Nikunj, I'm not. I don't really know their leverage positions, and I'm not really the right guy to ask these questions. We'll see once the report comes out what the extent of the leverage is, and if there's backed by assets or not backed by assets. So at this time, the best I can say is that remain invested.
Mr. Damani, you've always said that, look, for an investor, the importance of price is paramount, which is that when you're investing, buy something cheap. And there was a time, I'm just bringing this point for the benefit of our viewers, that you bought into airline stocks when even Warren Buffett was not buying into airline stocks, because you found them cheap and attractive. So in your definition, in this market where things are reasonably priced, what is cheap and attractive?
Well, Nikunj, I'll tell you the two new sectors that we've been trying to bet on. Some you may be familiar with. Data, as everyone keeps telling you, Nikunj, is the new oil. I mean, that's now a well-known fact out there. Now, data has a lot of components. You've got to aggregate it, you've got to analyze it, you've got to put intelligence out of it. Now, if you look at the companies in India that do specialize in data, I think their employee cost as a percentage of revenues is between 60 and 70%, which tells me two things: that this business is coming to India, because if India is paying 70% in salary cost for this business, it's clearly a business that cannot be done in America or London or Germany. It has to move to India. So there are a lot of new companies in there that are using data either to aggregate it in a database or ship it out in intelligent forms. So I think the first sector of new ideas, if you wish, is we're looking at those set of companies, because we believe that the cost basis of that business also almost ensures, given that we have now good telecommunication and cheap property prices, that the business will shift to India. The second business, which you, as you know, I've been bullish on the last few years, is particularly some of the defense and railway PSUs. And given the government's capex push in railways particularly, I think there's some very cheap stocks, I'll use that word advisedly, cheap stocks in the railway space. And if you notice the last few days, there's been a lot of noise of India becoming an export powerhouse in the defense sector. Now, if India is going to be an export powerhouse on defense, $5 billion is the number bandied around next year, I think a couple of listed companies which will have to benefit dramatically from that push. So I would say you go for data, and then I would still stick to some of the cheaper defense and rail PSUs, particularly because of the capex and export push that they're experiencing.
But are these businesses, especially the defense stroke railway businesses, are these high quality businesses? Because the top line may be great and the government commitment towards defense and railways is strong, but some would argue back and say that these are not the best of the businesses when it comes to return ratios.
Well, I disagree with that. I mean, I'll give you an example of a company that I still own, and I'm only saying it as an example, not for anyone to buy it or anything like that. So please be very careful. You remember, Nikunj, in the early 2000s, we used to buy a company called Bharat Electronics, which I own today also, but I'm not recommending it. I'm just saying that the stock from those lows, it was a 300 crore market cap, it's now a 60,000 crore market cap. So over the years, it's compounded for investors, paid a very rich dividend yield. So I get very a bit upset with people who throw the baby out of the bathwater. It is your job as an analyst to find the good from the bad, the good PSUs from the bad PSUs. Don't necessarily look at the resource-rich PSUs or the telecom PSUs, but others look at, just like you can fail in the in the private sector enterprises, so many businesses in private sectors have failed miserably. So then PSU, and the aggregate of taking all the PSUs in one basket and looking at the returns of 10 years is misnomer, because you're comparing apples and oranges. So you look at defense PSU separately, railways PSU separately, commodity PSU separately, and then you'll start making more intelligent decisions. So I completely and totally disagree that the return ratios are bad. In fact, some of these dividend payouts, return on capital, cash flow yields, corporate governance matches that I have seen in some of the better private sector companies. And at the end of the day, you're making money in them. I mean, that's always the test in the stock market, that are you making sustainable money in them? Because they're paying you dividends and they are, generating cash flow. And I think they are. So, I'm happy, if people are ignoring it, that's okay. It gives me an opportunity to buy these stocks cheaper, which I am. But, we're not necessarily wedded to PSU. We're wedded to good PSUs that are delivering for the shareholders. And we have lots of private sector companies. So if you're not comfortable, all means go ahead with the private sector companies. But if you're an analyst sitting in Bombay and trying to figure out cheapness and value and growth and prospects, I don't see how you can ignore that basket.
Mr. Damani, you've always, in a sense, emphasized the importance of mean reversion and market cyclicality. There are phases in the market where dividend yielding stocks have done well. There are phases in the market where growth stocks have done well. There was a phase in the market where infrastructure and commodity stocks did well. So for next 3 to 5 years, what phase of the market we are in, and what is the template which will work for an investor?
Again, the first template we believe, Nikunj, is that we are still in a bull market. That's very important of how you position yourself. We think the bull market will be driven by demographics and by India's geography. So any companies that can benefit from that, maybe it's inward-facing companies, maybe it's companies catering to a population bulge, housing finance, or anything else. And these data companies are, of course, export-facing, but we still think there's a value proposition there. So I think, having gone through the first 2 layers of understanding that we are in a bull market, we believe that Indian equities will do well, not over the next 6 months or 12 months. There's no idea how they'll do. But over the next 5 to 10 years, I'm fairly confident that they'll give you a good compounded rate of return. I would invest in those businesses that profit from the demographic bulge that you're facing, from the manufacturing impetus that you're facing, from the service sector that we're still very good at. And, the firm belief that if India is to now compete in the world, it needs to match China in terms of economic heft. So once you kind of understand that, I think it's much easier to find stocks that fit those criteria than, just being influenced by the price of the market going down for 2 weeks or 3 weeks.
Mr. Damani, when we met last time, we spoke about fintech and consumer tech, and you said that, look, you like the power of some of these businesses because they represent the new way how the demand and the societal needs would change, but you were not very happy with the valuations. Guess what? From euphoria same time last year, couple of months ago, there was fear. Have things normalized for the consumer tech and fintech stocks?
I think they have, Nikunj. I think they have. I mean, if you look at the numbers first, all the fintechs and the consumer tech companies report a very strong sales growth, but still profit is eluding them. How good is the sales growth? I mean, if you look at the quarterly numbers, at least, and divided by about, I would say 90%, about 600 million people are their addressable market. The per capita consumption of a food delivery company per quarter, or the per capita consumption insurance company, is like 10 or 20 rupees per quarter. So it's very, very low. And I think given the fact that India is going to add 250 million people in the next 30 years, 95% of those people will have access to a smartphone and will access to cheap data. And they've been born post-92, so they're post-liberalization children. And they only know the technology and internet. They're not used to long lines, ration queues, and things like that. So they will be eager beavers, in a manner of speaking, to enter into the fintech and consumer tech space, if you will. So once you look for, then the universe narrows. And I think they're ultimately good businesses, whether it's the food delivery business or the insurance business. They're good businesses, just came at an extremely incoherent valuation. The market has corrected that. I think if you start looking now more sharply, you will find value in the new tech businesses. And again, I would not try and look for a path to profitability next quarter or next 6 months. But as long as the sales growth remains strong and they have enough money to burn to last them till the profit comes, I think they'll be okay. So my advice is that an initial exposure to these new tech companies is probably warranted.
Right. We are looking at a very big change in the macro regime, which is that from an era of low interest rates and low inflation, we are now moving to a normalization of interest rates and high inflation. How will that change the investment template?
Well, that used to be the fear. I think that 40 years we had a bull market based on low interest rate, full employment, globalization, and the parameters of that have changed now. So we're going to have deglobalization, higher interest rates. Uh, my feeling is that I'm not convinced that inflation is headed to a higher plateau. Yes, it's been sticky and it's been bad. Let's take it India and the US or India and the West, if you will, just to understand what happens. Uh, India we've dealt with high inflation the last 40 years, and it tends to be sticky from a period of time. But India is primarily building a new economy, and the new economy, doesn't require a lot of the old amounts of capex expenditure or the old type of inflationary expenditure that takes place, because you need copper, steel, concrete, a few computers, and off and running for business. So I think we will see inflation from time to time, but it won't be as severe as it was in the 70s or 80s. Now, let's go overseas. Uh, if you go and see the new factories that Tesla is building or Amazon is building or any of the great companies in America building, they're being staffed by robots. And robots, Nikunj, as you know, work 24/7. So they're 3 times more productive as a normal human being. In fact, in America, you can't find people for a lot of jobs. So if you find that robots, which are cheaper and more productive than human beings, are replacing the human capital cycle, it points to deflation because you have productivity growth and you have lower employee costs. It doesn't point to inflation. So I think that, yeah, we went through a bad phase because we actually pumped up the economy too much in the Western world, and that led to high inflation. But I think beginning next year, inflation will moderate to around 2 to 3% levels. And I think my sense is the fears of high inflation trajectory are probably misplaced.
Mr. Damani, you've always managed to identify things ahead of the curve. And I'm again going to just expand on this question for a young audience who've not tracked your investing career in last 20 years. I've had the pleasure of tracking that, so I'm going to speak out of experience. You identified IT services in 2000. Then you were able to identify some of the consumer stroke financial NBFCs really ahead of the actual explosive growth. So if you have to, let's say, identify the high growth businesses of this decade, the mature businesses of this decade, and the decaying businesses of this decade, how would you club them?
Nikunj, you're putting me on the spot. It's a tall order. What I think will happen is, if you look at, say, new business, I think people that can use data efficiently, whether it's data center storage, whether it is, compiling data together, whether it's building an India stack, or whether it's using data for analysis and knowledge, I think those companies will do well. And as a sub-rider to that, people doing complex KPO operations, not necessarily the simple basic call center BPO operation, but complex KPO operation. I think given the high salary costs in the West and the problem finding the right people, it just seems almost logical to me that the entire businesses will, move to India. So if you now look, there may be a dozen companies in India that are specializing in data or specializing in complex, KPO type of businesses, not necessarily BPO businesses. So I think that will be at the vanguard of investors' interest for a period of time. In terms of decaying, I mean, a lot of businesses that are not tech enabled or not internet enabled. I'm on a spot. I'm not able to think. I'm sure there are a lot of businesses that will not be prosperous. I mean, there's a huge churn in even the S&P 500. Every 10 years, a lot of businesses get thrown out, and a lot of new businesses come in. So, that invariably will happen. But, I'm more focused on businesses that will grow and do well as opposed to businesses that, will decay. So maybe I'll take that question up more seriously on a next interview with you, Nikunj. But broadly, I feel the index, of course, you must remember the index is very wise in that matter. The index committee always throws out the old businesses, put in the new businesses, the ones with more promise, more market cap, whatever. So the market will reflect the reality of a new composition of business. And if you see the index maybe 3 years from now, it should be, in my opinion, higher than what it is now. And they will reflect not the old businesses, which will be out of the indexes, but the new businesses. So that's a good way to keep an idea of what the market is looking at this time.
Has the crypto bubble finally been pricked?
Which bubble?
The crypto bubble.
Oh yeah, absolutely. I mean, I used to for some time drink the Kool-Aid and believe that this was an answer to government's debasing of currency, maybe as a new gold. But I think I've become more cynical of late. I mean, you can't have a store of value that fluctuates by 60% in 3 months. It's just not going to happen. The sovereign governments are not going to allow Bitcoins to take over their lives. In fact, they will outlaw it if they are becoming a part of economic transaction. And I think it was, it reminded me in many ways of something called the tulip bubble or the South Sea bubble. Things that take place when people ascribe value to assets which have no underlying reason, but only because of a speculative fervor. So I think you're right, the bubble has burst.
When we spoke to you last time, we spoke about how you should invest right now so that your children could really benefit. So I'm going to take it slightly forward. If you have to create a nest egg for your grandchildren, 2 of them, 2 lovely grandchildren, how will you invest for them? How will you create that next egg?
Well, I'll tell you the good news, Nikunj, is that I'm actually doing it. I'm doing it as a real life experiment. I said, we can invest small sums of money for the grandchildren on their birthdays, and we just leave it unchanged for the next 10, 20 years, at least till they reach college age. And, they'll have a legacy, if I'm right, that the grandfather did something for them and the grandmother did something for them. So the first point I would like to mention, because this is a great idea, because if you look back at the last 30 years, people who invested very small sums in India, at 1,000 level of the index or 1,500 level of index, or even at 4,500 of the index, the March 92 when it topped out in the 92 bull run, still have made out like bandits over the years. Some have made 50x, some have made 75x. In the last 30 years, you could have done any number of things, but you remained invested in equity, you actually became rich. So with the belief that the past is going to be prologue and what happened in the past will continue happening in the future, that the Indian market remains to be excited, I think it's a good idea to, I would strongly think it's a great idea to invest for your grandchildren. Now, what do you invest? I mean, if you're someone who has no time to follow individual stocks, it's very simple. Buy an index tracking fund. When the market corrects, buy a fund that tracks the Sensex and Nifty, keep it for 30 years. If the Sensex doubled, you double the money. If the Sensex goes to 5x, as it has in the last, say, 10, 15 years, you'll make 5x your money. So it's a great thing to do that. Person like me who's more interested in capital allocation, more interested in finding stocks, we try and find stocks that are gleam in the eyes, small caps that can become mid caps, or perhaps even large caps over the next 10, 20 years or so. Unfortunately, the SEBI regulations, I can't discuss names with you, Nikunj, but I would suffice you to say that I have been doing it, and I'm finding things that I want to hold for 10, 20 years, and hopefully they will be right, and they will be a mother lode of value for my grandchildren at the end of the rainbow.
But when you're investing for your grandchildren, Mr. Damani, I'm sure you are more than companies, you are betting on themes, because that's what investors can do. You cannot specify 20 years down the line which company will make it big, but you can certainly specify that that area in which you are investing in, that area or that business or that sector could become big. So can you throw more light on that?
Yeah, I mean, we bought, to give you examples, some consumer companies. There are, just without giving names, there are watch companies that are trading at, not the Titans, but the other ones are trading at fairly reasonable valuations. We're seeing prospects look good. There are fintech companies. Finance is going to be a very important part of everyone's life and continue to be. Particularly in the right answer, I don't think Bitcoin is going to take over the rupee at any time in the next 40, 50 years. At least I don't think so. So, some of the leading fintech companies are, good places to park your money. Some of the businesses that I was well known for in the market in the 2000 era, the spirits company. I mean, as the immortal line in Diwars, when Parveen Babi turns to Amitabh Bachchan and says, he's drinking because he's happy, he's drinking because he's sad, he's drinking because he's friends. So these are almost universal businesses. So, a little bit of that in the portfolio. So, there are themes it might not be cyclical businesses because you don't know what the shape will be in 3 years, 6 years, 9 years of these businesses. But there's some business stories that are secular that would, I think, continue to prosper over the next 5, 10 years. Or the market cap is so small that even if it's cyclical, they will still fall from a much higher base each time. So it's a very difficult question to answer without giving you specific examples. Unfortunately, I can't give you specific examples.
Two more last questions, and this is just to inspire a lot of young investors. You always endorse the importance of patience and power of compounding. In your investing career, if you could share 2 examples for the viewers and for those who are watching the show online, that how power of compounding has worked for you, some stocks which you held on irrespective of what the macro and what the tone of events has been, and how you are now reaping the benefits of that.
Yeah, Nikunj, great question. I love to talk about this compounding because if you ask me what liberated me in my life and what made me financially free, it was when I understood compounding. Compounding is how your money becomes wealth. And, there used to be an old gentleman in the last street who, you must remember, I'm an MBA. And despite that, I learned the compounding lessons from an old friend of mine called Chandrakant Sampath, who unfortunately passed away a few years back. And he used to sit down and explain to me the power of compounding. And he would say that if you can get your money double every 3 years, no matter what amount you start with, at the end of a 30-year period, which is your professional career, you'll have 10 doubles. And at the end of the day, you'll be a very rich man if you do that successfully over a period of 30 years. And you must recall that for a lot of us, between 95 and say 2005, 10, 15 years, the very low capital gains tax in India, very low tax on dividend. So we compound at those rates for long periods of time and add substantially to our wealth. So we were very lucky in terms of that generation. But the point is that you can start with 5 lakhs, 10 lakhs, it doesn't really matter. The important thing is to first invest in appreciating assets and not depreciating assets. Because appreciating assets you could get wrong, maybe it won't work, but maybe it'll compound for you. Depreciating assets like buying a very expensive car or taking a very expensive vacation or buying a very expensive clothes will almost certainly go to zero over the next 3 to 5 years. So the first rule of law is that you buy and invest in appreciating assets. The second rule of law is that you hold it for a long period of time. Compounding gives you magical returns. For example, as I pointed out to you, if you invested in 1990 when I came to India at 1,000, today you've made almost 60x your money, is surely in terms of the index. Okay, so long-term Indian equities have returned about 15-16% CAGR. Okay, if you add dividends, add another couple of percentage points to dividend. If you can do instead of 70-80%, maybe 21-22%, that means your money is doubling every 3 years. And you can start with almost any amount of money, Nikunj, 5 lakhs, 10 lakhs, it doesn't really matter. At the end of the 30-year period, you're going to be fairly rich if you follow the principles correctly of compounding money at 21-22%. Unless you can't do it 20%, let's say it's too much a burden after taxes, after losses, all the company. Okay, compound at 15-60%, double your money every 4 years, double your money every 5 years. You're still going to be in with a motherload of returns at the end of 30-year period. And that's the way to view the stock market, is that you want to view it over a 30-year period. You want to say that I'm going to do what I want. I'm a hairdresser, I'm a lawyer, I'm a software engineer. I will continue to do what I'm passionate about, build buildings. I don't care what you want to do, build buildings. But if I have money that I save or in excess of my expenses, that you need to invest and grow at that 18-20%, if you will. And if you do that, you're not only going to be successful and happy in your professional career, but you're also going to be financially free. And that's the goal. I mean, when you're 60 years old, you want to be able to take care of your children's education, your parents' health, your housing needs, whatever. And that's the reason you're building up. And India is giving you that great, stable tax rates, great universe of companies, and a great opportunity that over the next 20, 30 years, the index will be substantially higher than it's today. So there's a lot of feeling, Nikunj, that, oh, you're lucky. That's why you're saying that because you came, the index was 1,000 and it's now 60,000. So you guys in your generation were the lucky one. You benefit from all that growth. But I will say with deep respect that I believe the next 10, 20 years will be as exciting as the last 20 years, at least in terms of stock market returns. So if you don't have a demat account or you don't have exposure to stock, I would think that it's a good time to, take care of those two and think of yourself for the next 10, 20 years rather than the next 2, 3 quarters.
I would request everybody to watch and revisit and rewind and watch Mr. Damani's answer again on the power of compounding and how all of us should really apply that not only in our investing life but also in our daily life. My final question, sir. It's been 9 months, sad, true, disheartening. India has lost one of its most famous investors, Rakesh Jhunjhunwala, a common friend and a very dear friend of yours. What do you miss about him?
First of all, on budget day, it was very hard for all of us. I know a lot of people in his office. We all, as friends, get together for a post-budget party. And the most sought-after opinion on budget day was always his. And, Nikunj, it's actually astonishing how many budgets he got right, starting with Madhu Danwade's budget to the last Sitaraman's budget where he said the bull market's continuing. I don't care what anyone says. He always seemed to be on the right side of the budgetary moves. He was always bullish on India. I think some of the lessons we learned from him still resonate very deeply within me. I miss him in so many aspects. I miss him as a friend because we were socialized together. I miss him as an investment guru who taught us how to think, taught us how to look at Indian markets. And I miss him as a strategist, someone who actually put into my head that be bullish in India. You need to understand what's going on. It's very easy to be cynical. So there are many, many facets of Rakesh I missed. And I think just to add to the last question that you did, I actually did his compounding returns in his career. I think there is nobody in the history of the stock market or the history that has compounded wealth at a bigger rate than he has in the world. I'm saying that he started with 5,000 rupees, Nikunj, as you know, and he ended up with $5 billion plus. And I'm being charitable; it's probably more than that. That gives you a dollar compound rate of about 45, 50%. A dollar compounded rate. Warren Buffett compounds at 20 to 23%, and he's on every magazine cover in the world in dollar terms. And here's a guy who 30 years did it at about 40, 50%. So he's truly iconic, truly one of a kind. And I'm very grateful to the government of India to honor him with the Padma Shri as they did recently. And, he will always be missed, but his learnings in terms of, how to approach the market, how to think about businesses will always stay with us. And as they say, a teacher affects eternity because his legacy never stops, and neither will his.
And what an extraordinary human being who's really inspired generations of Indians that why to believe in India, why to bet on India, and more importantly, how to do it in an efficient and a very fair manner. So Damani, really appreciate your time. I'm so glad you found time to join us. And here's a sincere request from everybody who's watching the show that please find time to join us more often on ET Now.
We'll do that, Nikunj. Thank you so much for having me today.